Okay, as people join in, I want to welcome everybody to Fireside Chat, Finance Capital Markets. Hi, I'm Nisha Sridhar, Marketing and Events Manager, and it's great to see you all here today. Next slide, Astrid. It's with gratitude and respect that we acknowledge the lands on which Foresight operates are the traditional, ancestral, and unceded territories of the First Nations, Inuit, and Métis people. And for myself, I'm speaking to you from Calgary, which is within the Treaty 7 territory. These are the traditional lands of the Blackfoot Confederacy, the Siksika, Kenai, Piikani First Nations, the Tsuut'ina First Nation, and Stoney Nakoda First Nation. Next slide. Here's the agenda for the day. We have an experienced panel here, and we will have panel introduction and a moderated Q&A. Please use the Q&A option to post your questions. Next slide. Before we start, I want to say a few words about Foresight. Foresight is Canada's cleantech accelerator, and our goal is to make Canada the first G7 country to reach net zero. We work tirelessly to position Canada as a global leader in clean technology. We bring together cleantech innovators, industry partners, investors, government, and academia to address today's most urgent climate issues and support a global transition to a green economy. Next slide. Over to our panel. Nishka Gupta from ARC Financial, Terry Booth from RSM Canada, Sally Morris from Women's Equity Lab, and James Chippeya from Foresight, who will be moderating this session. Let's start with Nishka Gupta. Over to you, Nishka.
Fantastic. Well, good morning, everyone. Nisha, thanks for kicking us off. It's a pleasure to see how well attended this session is this morning. I'm Nishka Gupta. I'm a Senior Vice President at ARC Financial. For those of you who are not familiar with ARC Financial, it's a private equity firm that's focused in Canada and Canada first and North America second. We only have one office in Calgary and invest North America wide. ARC has been around since 1989 and investing since 1994 in all forms of energy. And I've specialized my whole career in energy investing. Most recently, I'm doing a lot more climate tech and clean energy technology focused investing. So I'll be taking a more of a energy technology perspective in this panel. And the other thing to mention is most of my investment history is in the private equity realm. So a little bit more mature investing than the VC investing that many of you would be seeking capital for your companies in the first couple of rounds. But at the end of the day, a lot of these companies will eventually require funds either from more mature public markets or from private equity investors. So really trying to take a look at what are those eventual investors looking for in the companies that you're building. And if we're building companies looking at 5-10 years in the future today, then we're giving those companies a greater chance of success in the future. So that's the perspective I'll be taking today.
Thank you, Nishka. Over to you, Terry.
Great, thanks, Nisha. Happy to be here today and great to see everybody on. Just a little bit about RSM. RSM is the 5th largest accounting, tax, and consulting firm in North America. We are a little bit different in that we're focused on mid-market companies. My role within the firm is I am the tech sector leader for Canada. And in that role, I work with all of our service lines to help tech companies thrive and succeed. We work with companies right through the life cycle, right from pre-revenue, early stage through to exit. I'd say my portfolio of clients and a lot of work that I do is with companies in that right from I'd say seed stage up to series A, B, C. So work a lot with companies that are looking for VC money and work with founders in helping with strategies around getting financing and how to position and how to have a competitive advantage when you are talking to the funders. We also work with a number of private equity funds. We've got a significant private equity practice in the US and in Canada, but also work with a number of the VC funds. So we also see the investment landscape through the funders' eyes too. So that's probably enough about us.
Thank you, Terry. Over to you, Sally.
Hi, everybody. I'm Sally Morris. I'm a managing partner with Women's Equity Lab in Toronto. I'm also on the advisory board of Women's Equity Lab nationally, as well as being an active angel investor with Maple Leaf Angels, where I sit on the investment review committee. Just a bit about Women's Equity Lab. It was founded in 2017 in Victoria, BC, by a woman with the objective of creating more female angels. Women comprise less than 37% of angel investors and are even less represented in the VC investments. Less than 3% of equity investments go to women-led businesses, and we're trying to change that by giving women the opportunity to learn how to angel invest collaboratively as part of a group. We operate across Canada and in the US. Victoria is on its 5th fund. Vancouver and Toronto are on their 2nd fund. And this year we expanded into Manitoba, Silicon Valley, and Atlantic Canada, where we're in the 4 Atlantic provinces. We now have a community of over 180 women that have invested over $2.5 million in 31 companies, 70% of which are women founded or led, and many of which are in the clean tech space. Thank you.
Thank you, Sally. And over to James Shapira from Foresight. And he will also be moderating this session.
Good morning. Welcome, everybody. Today, let's have a little bit of fun. We're going to talk about capital markets. We wanted to look at where they're going. I actually challenged everybody to come back next year to make their predictions and see how they stick, but no one wanted to take me up on that. So I think I'll probably be the one that is going to take the most grief for what I have to say. Then next year, when we go through this, when you look at capital markets and where we're going, the first thing I think is worthwhile is getting a sense of setting the stage where we came from. And if you look at over the last number of years, what happened, we had this period of like generationally low. We're talking about high interest rate environments right now, which is kind of funny when you consider that generationally we didn't actually have an interest rate. They were so low. So that's an element that's come into play. Then we get into COVID situation and the amount of money that was being put in liquidity and changing the dynamics there. And now we've come out of the other side of it. And what I'd like to challenge our panelists to do is give us a sense for where we see this going. So in 2021, record year, we had almost over $750 billion in exits by way of public IPOs and de-SPACing of companies. Like 87% of those were actually buyout way of IPO. The IPO landscape has really shifted. And why I'm focused on that is ultimately like when you're looking at the early stage, ultimately you're growing to get to a point and where you want a liquidity event to take place. And so you need to be looking at, as somebody famous once said, where is this puck going? One thing that I noticed when looking at how the markets have been operating is that since 2009, the median income for companies when they IPO'd was actually a loss. So nobody had been making any money. The venture capitalists, the investors had been funding companies for subsidizing their business models and pushing growth over income. Now, there is merit to it, but I'm wondering, want to get your guys' thoughts on how do you see that playing out? Now, obviously, the last point I'm going to make is before we turn this over is the valuations of the companies we saw this in public markets, which is a driver. They were significantly overheated, but those were also overheated in private markets. And when you saw, and I hate the metric, but let's use it anyway. So the price revenue valuations were actually under 9 at the beginning of the pandemic. And over the course of the pandemic, by halfway through 2021, that pricing had actually shifted to 24x. Now that's not sustainable, clearly not, and it is now cratered. How do you see what investors are going to be looking for? Where are they going to be focused? How do you see this dynamic evolving over the next year so that our companies can be focused on how do they communicate with investors, recognizing where we came from, where we are today, and where it's ultimately going to go? And I'm going to turn that over to Nishka first, and I'm just going to let the audience know please put your questions in the Q&A. We can respond to them there, or we can raise them up in the discussion, but it'll be easier for everybody to get responses that way. Nishka, do you want to comment on where we are, where we're going?
Sure, thanks, James. I'm actually gonna just try to share a couple of slides here because you raise a very interesting point on valuations. And I just want to actually share some data before we begin to impress on what happened in the last 2 or 3 years, because that really helps inform what we think might happen in the next 2 to 3 years. So I'm just gonna bear with me for a second here while I share my screen. Can everyone see my screen? Great.
Yes.
Thanks for that. So I think this first slide is courtesy of Bloomberg New Energy Finance. It's just a copy paste from one of their reports that I tend to follow. And this is really putting a finer point on what James was talking about. Has the market changed? Yes, the market's changed. This doesn't even really look at the very high watermark of 2021. This is comparing the last quarter that we have data on. So this would be the last set of data that we have here, second quarter of 2023, and it's comparing it to the rolling average of the previous 4 quarters. So what this is showing is, yes, it's negative across the board. Generally speaking, funding is down. So you'll see, and this is climate tech. I know it's a subset of what many of you are focused on, but it's not that different. Climate tech wasn't that different than the rest of clean tech. So we're just going to use it as a proxy. And this is global. Most of it is in North America and Europe, I would say, the focus. China is included in this data, but it is global. So what we're taking a look at here is, energy, surprisingly, wasn't very bad. Transport, so this is electric vehicles, which we all know were extremely heated in 2021 and 2020, just coming out of the pandemic there. That's down more than 50%. And then climate, industry, agriculture down some lesser amount, and buildings and infrastructure is actually up 15%. Deal count and deal size hasn't really changed, which just means, series A, B, C, generally it's the same investors and the same check sizes that are playing in the market, but the market is down. It's not as down as drastically though, as one might think. Like, that's something I want to point out. Overall, when you do the numbers, I think because energy is such a large piece of the pocketbook and it's only down 12%, the overall numbers shake out to roughly 15 to 20%. So just want to acknowledge that, yes, I think IPOs are down very drastically because the markets is not as frothy. But in the private world, VC and PE investing is still continuing, and it is healthy compared to historic levels, perhaps down compared to 2020 and 2021 levels, but it's still quite healthy compared to historic levels. So just wanted to set the stage with that. And then getting into valuations a little bit, and this is something that Peter Tzatkian, who is the chief energy economist at ARC Financial and the head of the ARC Energy Research Institute, he's put together this thought exercise on valuation. So I've borrowed a couple of slides from him. But what I'm showing here is subsectors and how much the valuations have deteriorated over the last 12 months or appreciated over the last 12 months. So you can see some of the really overheated sectors like hydrogen, those that were very much in that clean tech, those were down by more than 50%. And these numbers are as at April of earlier this year. So they're a little bit dated. I would expect that some of these numbers have declined even further, but some have actually recovered. So again, what does that tell us? It tells us that I think markets were moving in tandem because there was a lot of euphoria about clean tech in 2020, 2021. And now investors have become more attuned to differentiating between the different sectors and differentiating between companies that are actually offering a strong value proposition versus companies that are riding the wave, so to speak. So I'd say that, you can see some of the sectors are actually up. Solar install and solar panels are in the positive. Oil and gas had a big run after the pandemic and is generally flat year over year between now and last year. But energy storage, so batteries and hydrogen and electric vehicles, things that were extremely heated, especially in the transportation sector and the fuel sector, have really come down, right? If I just really quickly, this is a very interesting one. So this is actually showing in 2022 when valuations had already corrected a little bit, but not quite as much as they've corrected this year. What would the price earning multiples and what were the multiples that some of these companies were trading at? These are all public companies, by the way. So look at hydrogen, price earnings multiple not available, right? So in general, that entire index had negative earnings. So I have to ask the question, love for some of the other panelists to weigh in on this as well. Should those companies ever have been public? Were those companies at an appropriate stage for being public, right? Now, in contrast, if you take a look at exploration and production companies, which is just a proxy for traditional oil and gas companies, they're trading at price earning multiples of 7.3 and EV to EBITDA multiples of 4.3. So there is a fundamental return that they were offering. So I would almost argue that the correction was inevitable and the writing was on the wall because, to James' point, it was a bit unsustainable, right? Electric vehicles, the price earning multiples are positive, but 82.7 is almost like there was no earnings at that point in time. So where is the puck going with this data? I mean, I think some of these sectors have actually not fully corrected still. And I think you're going to continue to see more bifurcation between the sectors and between just companies in general. It's not even sectoral. I think it's company dependent. Investors are just starting to focus on the fundamentals more. It's a tough fundraising environment for everybody. So they need to be able to show returns and they need to be able to show fundamentals as they make those investments and part with precious capital. So as long as the companies are actually offering a value proposition and can explain how those price earning multiples start to look more reasonable in the next 4 or 5 years, the capital will be available. That's sort of as much as a prediction I'm willing to make, James, but over time, markets will come back, they'll become frothy again, but we shouldn't be treating those market cycles as an opportunity to make a quick buck and then expect that type of frothiness is going to stick around, right? At the end of the day, if we're building companies for the next 5-10 years, we need to be able to live through the various market cycles and build robust companies that actually offer real value proposition to the investors. So I think as long as companies are doing that, you're going to see investor sentiment be there and capital availability be there. But it's not going to be as frothy for quite some time, because investors' memories are, are long, especially after they've been burned. So I would expect that they would continue to be cautious over the next little while.
I could not agree more. I really appreciate that, and I really the point here is that we're a lot of people talk, and there is that saying about if it bleeds, it leads. So there's we kind of make it too much of the correction. The correction needed to take place, and I think the correction is a healthy thing because those valuations were just not making any sense. But Terry, do you want to add anything to that?
A bunch of things, but Nishka, first, the short answer is no, those companies shouldn't have been public. I think we saw during the frenzy of the SPAC markets that there was a bunch of companies that went public that just shouldn't have been public in the first place. The business model wasn't mature enough for them to be in the public markets, and that created a lot of that frothiness that you see, and that also created the lack of an IPO market today and going forward. So I certainly agree that we think for the next year or two that IPO market is not going to be a lot better than it is today. We're starting to see some activity in the IPO market, but it's certainly not going to get back to those levels that it was a couple of years ago. I guess a couple of things that I wanted to talk about is, with the IP market being slow, I do think that means those companies that are looking for exits, that the value of strategic investors and corporate investors in that model has become enhanced again over the last couple of years. So you are seeing we're seeing a lot more M&A activity, and we're seeing a lot more of exit to strategic investors rather than the IPO market. I will say, and James, you sort of mentioned this in your lead in, is that does mean that there's an increased focus on profitability. So growth for the sake of growth is not attractive to investors, and it's certainly not attractive to strategic investors right now. I think growth with at least a plan to profitability is extremely important when you're looking at how do you get to your exit, and when you're talking to strategic investors, especially if it's a strategic investor that's a public company, I think a short-term path to profitability is a minimum, if not profitable on day one. The flip side that I want to talk about a little bit, though, is although the exit market or the IPO market is slow, I think if you look at the early stage funding for clean tech companies is actually very strong, and it's remained strong through COVID. But if you look at the last couple of years in Canada, the VC investment in Canada last year in clean tech had the most deals and most dollars ever. And so far for the first 2 quarters of this year, it's looking like we're going to outpace last year. So that investment market for early stage companies in the sector is very strong. And one of the interesting pieces last year was that 85% of the VC money in Canada went to early stage companies. So it wasn't those companies that were beyond their scale up stage. It was companies that were just in that scale up curve. And I think there's a number of reasons for that. One, that probably means you don't have to deal with the complexity of down rounds. And in a bunch of cases, we also saw a number of deals that were unpriced deals, which is a lot easier to do with the earlier stage companies. And a lot of that had to do, and we've mentioned a couple times before, that valuations have been fluctuating, to put it mildly, over the last few years. We're certainly seeing valuations come, and I think everybody's mentioned it so far, as valuations are sort of getting back to where they were pre-COVID, and some of us think that means there's some level of sanity to them finally, as opposed to what was happening during COVID. the issue has been in the VC market is there's been such a large gap between what the founders see as the valuation and what the VC sees as a valuation, that it's been hard to get deals done. When that gap's too big, it's just hard to meet anywhere in the middle. So, you know, we've certainly seen because of that a lot of the unpriced rounds, but also I think that's creating some of the slowness in deals in those later stage companies. So I think that's maybe it for me for now, James. I can add 30 more things if you want, but
okay, we'll get back to that. Thanks, Sally. So, okay, with all that stage set, you need to place capital. That's your job. You need to get the capital out there. So how do those companies get your attention? What do they need to be doing so that you're actually prepared to look at it and say, because yeah, there's corrections that take place. That's fine. There's going to have to be at some point you hit a point where you can the deal gets done, but there is the demand for capital right now does outstrip the amount of availability. That clearly is there. It's like probably at least a 5x now as far as demand supply, and it's not necessarily the demand there being because it's from good companies that are there, but it's just there's a lot of demand. People are trying to do deals. So how do they get your attention? What do they need to be doing, and what is it that you're looking at now in this environment?
Well, at the angel side of the market, there's always funding available for good companies. So, you know, what does that mean? I think there's much more of a focus on profitability, as we've already said, a pathway to profitability, as opposed to just simply looking at growth. Cash is very important, making sure that there's enough runway in the company to execute on their growth plans. Some traction, definitely. You know, we have seen valuations come down. I don't personally think that is over yet, and I think that there are companies that did raises in the heydays, and they now need to raise further cash, and they're trying to raise at flat valuations. But I think the reality is, if you want your raise to be successful, you have to, it's a bit like selling your house. You got to forget what you paid for it. You've got to price to market, and the market is lower. So I think it's a very difficult conversation, and it complicates things, of course, in a down round. But I think it's a conversation that needs to be had. Valuations have to be reasonable for investors to come in. And another comment I would make is that in the heyday, in the frenzy of the last few years, there were additional exits for angel investors. You could be taken out by a VC or a private equity firm raising another subsequent round. Those exits are gone. So people are very much looking at the fundamentals of the companies, looking at the management teams. Are they nimble? Are they able to react to the market? So it's not that different of a market, but I think it is, in the sense of we're back to the fundamentals of what makes a good company, and that has become more important.
You know, and that is something that I actually really like, because you have to say, how do you build a real company? What's that real thing? Now, valuations is only one element of this, though, when you're looking at those deals. Like now what we're starting to see, though, is, and this is where I think some problems come into play, where investors recognize there's an opportunity to not just value adjust, but deal term adjust, which that can be very problematic for the management teams and other investors, because they say, well, you know, if I'm going to do this deal, I'm looking for those liquidation prefs that, you know, could be company killers. Any thoughts with respect to that? And are you seeing that? And how do you actually adjust for that or manage in that environment? Sally, I'll leave that
Yep,
with you.
back on me. Sure. I am seeing that, and you know, it's never a happy situation when you're an existing investor and you see investors coming in after you at highly more attractive terms. On the other hand, if it means that the company is going to be able to raise the funding they need to execute, it's a good thing. And I think how a lot of companies are selling it is to say, you know, why don't you invest in this, hedge your bets? You know, if we sell for X and you come in here with a 4 times liquidity preference, that's going to, you know, wipe out your your one-time preference that from back in the round that you invested in a few years ago. So they're not easy conversations, but it's definitely happening out there, and it can be a good thing. I guess the key that you, as an investor, you have to believe that the company is going to survive. And, you know, are you throwing good money after bad, or are you actually hedging your original investment? And I think that's kind of the decision point. But
Thanks, Ellie. I'm gonna actually put that back to Terry, because like if somebody came to me with a 4 times liquidation pref, it's like the company's like, from the manager's perspective, it's dead. There's nothing left in this. They're like, why bother doing it? Just, you know, there's no way you could possibly make money at that. So why do it?
Yeah, I'd certainly agree is that as you go forward, both management and the existing executives need to actually think about whether that deal makes sense to them. And I think Sally had a good point is, you know, if it's the only option available to the company, you need to think about whether there is a way for management or the existing investors to participate in that round. Obviously, the returns you're going to get are not what you were thinking your returns were going to be during the last round of financing.
Right.
At the end of the day, you can probably, you know, in most cases, we've seen that both the management and the existing investors can I guess negotiate or participate enough in that next round that there is incentive for them to continue on. You know, I'd certainly say though that I think the key part of all of this is making sure that both management and the founders, but also if you have an existing VC, or if you have, you know, a group of angels or a large angel investor, is you have to include those people in the negotiations on that next round, and they need to you need to have their buy-in in terms of moving forward, you know, and at a minimum, you should be giving all of those groups, if you can, the right to participate in that next financing. That's what's going to keep management and your previous investors engaged. It's a tough process, and you know, I think we've all mentioned it, is, you know, having that discussion around a down round or having a discussion around some of those liquidation preferences are very difficult discussions. But you know, I think, and we're starting to see it, is I think founders and management are finally coming around to the fact that those valuations that we see during COVID were just not sustainable in any industry, and we're back to some level of normalcy, and we just need to figure out how that's going to impact our plans going forward.
Yeah, and so you'd raised something I want Nishka to really talk about, because your really important point is that there isn't that follow-on, like when you're looking at how do you get for these companies, it's not sufficient to just finance the project. You have to keep in mind financing the entire plan. So this is going to take some time, and it's not just that round that is important, is how does that round fit into the overall plan with respect to that. And yeah, so Nishka, your thoughts on that, because you're looking at ultimately, like, even as a PE, you have to be able to get off your position at some point in time, and it may not be the public market. There, like, historically we've seen secondary markets, we've seen other exit opportunities, but now it's more of a challenge because you don't have line of sight to that. So thoughts as to how you're put together those financings, and what, and are you seeing as well those deal terms that how do you manage it? Could they be overly problematic to exercise on the plan, or does Terry and Sally right that so long as all the investors are buying off on it, that means the company survives? Thoughts on that?
Yeah, let me so I think private equity investors' perspective is not going to solve this conundrum, right? Because there's a gap that we've identified in the expectations, not just on valuation, but deal terms in general from management and what investors are at. And investors tend to overcorrect, right, once they've been burned. So as time goes on, I think that you're going to see that gap naturally close somewhat, but we don't know how much time that's going to take. And companies need to eat, so they need to survive, so they need cash now. So what do you do in the interim? We are big fans, James, to your point, of fully funded business plans. And what that really means is think about how much money is your company going to need to become sustainable. I think one of the traps we have become very comfortable falling into is thinking round by round and going for the highest valuation possible and best deal terms possible with the lowest amount of dilution you can get in a round. That's great. You're successful, market was frothy. That's going to create a lot of problems for you in a market that's not as frothy, because now when you have to do a down round, even if it's the best thing for the business, best thing for that technology or that solution to get out to market and could still be an attractive value proposition for management, it's going to be really hard to get that deal done because there's a lot of stigma associated with down rounds or investors coming in later ahead of investors that have lost money, or and then people tend to hold out. I've seen, and then those companies are in that valley of death, which nobody wants to be in. So I think we tend to capitalize our businesses with something that we like to call the equity line of credit. Now that's very much a PE construct. I'm not suggesting that VCs follow it, but at the end of the day, what we're trying to do is we're trying to say, okay, this company, in order to become successful and generate its own cash flow, which it can then reinvest to grow, whether or not an exit window is available. And if an exit window becomes available, that's fantastic. If it doesn't become available, the company should be able to survive. And how is it going to survive? It needs to have sustainable cash flow, that it's self-generating beyond a certain amount of investment that's gone into the business. So I think that's how we should all be thinking as investors and as founders. What is it going to take and to fully fund your business plan to sustainability? And maybe you have to do it in 2 or 3 rounds, but price your rounds accordingly and talk to your investors about the next round and the round after that. Don't promise. I think I've seen a lot of businesses say, okay, this is the last round. And then 2 rounds later, this is the last round. I mean, really, was it ever the last round? Did you ever really think it was the last round, or was that just a sales tactic? So I think the more honest we can all be with each other about what is a business truly going to need, the more honest we can be with founders about what our true cost of capital is. I think from an investor perspective, that's really important to say, hey, my dollar has this cost of capital, and on a risk-adjusted basis, I need you to deliver that cost of capital, right? And if founders and management teams start to think, okay, that dollar that I'm taking from someone has a real cost of capital associated with it. It's not just money I can leverage the way I can grants and other funding amounts. It's not a means to just exiting your own position, right? So I think we all just need to get really honest with each other about what we need and what we're hoping to build. And I know it just sounds like holy grail motherlode type of stuff, but in talking to founders and management teams, those are the best outcomes I've seen, is when people are able to sit down very collaboratively, come up with terms based in a real honest evaluation of what you need, those businesses, even if they don't have economically successful outcomes, they develop resiliency and pathways, right? They know that sometimes it's time to part, sometimes it's time to find a new investor for the next round, but you've already had those conversations and they don't come as a surprise to anyone. So you can build yourself that optionality and resiliency. So again, not solving any problems here, but it's just a mental framework that we can all get into to help companies succeed.
I would totally agree with you. Sorry, Terry.
Yeah, I just wanted to jump in. Sorry, James, and I think, and I'm sure Sally will agree with me, is in a lot of cases we see a lot of companies that are out raising money, especially in the angel space or that seed capital space, without that plan on what the additional rounds of financing look like and sort of what it's going to take for them to get to profitability. I think, you know, part of the reason that there is that challenge in the market is that a lot of companies during that bubble during COVID, you know, took money in without understanding what that plan was. And I talked to a lot of startup companies to say, okay, it's great that you're out raising $1 million in your seed round, but what's the plan after that? Like, what milestones are you going to be able to achieve with that money that's going to allow you to do the next round of funding? And then what's that funding going to get you to? And then how many rounds of funding do you actually need before you're profitable? And we see that as a problem with a lot of our early stage companies, is that they're not thinking through that whole piece of how do I get to be a sustainable company? Because a lot of times it's not the $1 million that you're getting in your seed round, it's the series A, B, or C where you're actually profitable. And absolutely, you know, I think of, because I have a lot of gray hair, I can go back a lot of years. I think of, you know, when we were talking to founders 10 years ago, and we warned them about bringing money into the company at too high of a valuation early on because of the impact it has on future rounds. And now we're seeing the impact of that right now is we have a lot of companies that took money in at valuations that just weren't reasonable. And now we're seeing the consequence of that.
Sally?
Yeah, I mean, I agree with everything that's been said. I guess in terms of and answering an earlier part of your question of what can companies do in fundraising in this environment, I think one of the things that is key when you have raised money, no matter what valuation, is that you build a relationship with your investors and that you keep them informed, you continue to report. All of that is so important, and that when you have bumps in the road, that it's not a surprise. You know, nobody wants to have something come at them out of left field. And in the case of early stage companies and angel investors are investing their capital for a return, but they're also very happy to help. They bring a lot to the table. And so if you're open and honest and seek help at the beginning of an issue, you know, you probably have a much better chance of success. And building that relationship with your investor base is only going to help you, you know, in good times and in bad. So that's something I would encourage. And the other thing I think in this market is to raise as much of the non-dilutive funding as you can. There's a lot of government money available out there, especially in this whole, you know, green tech space. So to get what you can, and often you can leverage a small equity raise and have it matched, you know, 3-4 times even with government money. That's a great way to fund your company.
Thanks, Alec. For the panelists, take a look at, there's some questions in there that you can answer, and I'm going to pose the next stage because I want to sage advice here. It's not a project. Fund the plan, finance the plan, show the plan, show how you're going to get. I love that the moving target. It's like we'll be profitable at some point. What I'd like to is shifting it a little bit to the other side. So not just what the companies are doing now. Let's talk about what the investors need to be doing. There's capital investors are out there. There's a lot of them. There's a like unbelievable amount of funds. They're all competing against each other because they need to show to their investors that return. That's what's going to allow you to generate your next fund, right? So like if you can't show that return, you're not raising another fund. So I've seen quite a bit of differentiation being trying to take place in the post, shall we say, post overheated tiger global type of markets where we just find I love to say that at that point they were looking for somebody they could fog a mirror and they would waive that if they had to. It's just get capital out. Now that doesn't work anymore. So you need to be able to show returns to your shareholders, your LPs. What is it that you're looking for? What's going to really grab your attention as far as where you want to place capital? Nishka had a great point out there. When you start looking at these sectors, there's some that I just like wouldn't want to touch with a 10-foot pole because there's no path to ever generating that return, no matter what's going to happen. So what do you think is going to be interesting and exciting over the next 12 to 18 months that is also exciting? Because I know investors are really interested in the clean tech, and there's some ESG going on. But what do you think will generate those returns that you need to see for your LPs? Sally, I'll put that back to you and then we'll finish off.
I guess just generally, looking at a company that has a good sized addressable market, and looking at how quickly that market will grow. So I guess that's always kind of the first point. And then it goes back to just the fundamentals of the management teams, the runway to execute on the business plan, with a pathway to profitability. So those are the things really that we're looking at. While I've got the mic, I just wanted to answer a question from the chat as well, which is, do we only invest in women-founded companies? And the answer is no. We have a preference for women-led businesses, but we do invest across the board, and about 70% of our capital has gone to women-led businesses.
Thanks. Nishka.
Yeah, it goes back to fundamentals, to Sally's point. I think what we look for is high quality management teams first and foremost, because there's a lot of other risk that's embedded in these early stage companies. The technology may not pan out, competition might catch up to you. Execution is not just about the internal things you can do. There's a lot of macro risk. The governments have big say in how clean tech, especially in the energy world, how that landscape is going to evolve. There is a lot of stroke of the pen risk. So what can we do to invest is really management teams. It's always been a core tenet of how we invest, but it's become even more important. Are you investing in people that have the ability to think through multiple years, right? They're thinking ahead, they're building partnerships for the long term, they're keeping you informed. So if something is panning out because of luck, but the management team is poor, versus you really believe in the management team and you hit a few bumps in the road with that company, that follow-on check is likely still going to the management team, where you've maybe hit a few bumps, but they can explain everything. They've got their risk mitigation strategies in place and they're building a robust business. So I think that management team piece is a really, really key. And just one thing I want to say, I think there's a question in the chat, what are the tactics that you can use to think through 2 to 3 rounds ahead? I think one of the things you can do, this again goes back to management teams, is just build very purposely teams that will challenge each other. And I think that'll help think through the future. We've seen too often that you've got a team that is just extremely positive all the time. And, the CFO, the COO, the CTO, is positive. I think we need to start balancing teams with people that are glass half empty, glass half full. And that'll help really think through where the business might falter, how much more money you might need, and it'll bring a lot more robustness to pitches. You know, from an investor perspective, I do want to say, I know we're nearing time here, so I do want to provide a very positive outlook here as well. If you look at what is required to get to net zero, which a lot of clean tech businesses are helping do, there's a report by the IEA that you should be able to access online if you just go IEA net zero scenarios or sustainability scenarios. And by 2030, we need $4 trillion per year being invested in the clean transition globally. Right now, in 2022, which was the highest year ever on record, we're sitting at 1.2 trillion. So we need essentially more than a tripling of that number. And 2023 is going to be lower than 2022. And 2022 was the highest by a mile. So if I take a look at 2015, 2014, which was more normal history, that number was less than $500 billion. So you can imagine, like, we're talking about tenfold increase in capital coming from investors, and the governments, it takes them time to get the right strategies in place, but they are committed. They're more committed than they've ever been to put the right incentives and policy frameworks in place to really encourage investment. So I think if founders can show robust businesses that are capable of addressing the problems we need to address, the capital will become available. We just need to make sure that we're not making bad decisions. We're not investing in extremely frothy markets, because that is what tends to set us back. That'll set us back 2, 3, 5 years, because investors will become super cautious. So I think we need to give this a little bit of time, and investors will start to increase their appetite again. And then we just need to make sure that we're building really robust businesses that are serious about generating impact and generating return. And I think that's how we're going to be able to get to a much more healthy investing environment.
Thank you. I was wondering what you were going to say, and I would have been shocked if you had not led with team. I know how you guys operate. It is, in real estate, it's location, 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 and from your side, it definitely is team. And it basically, Sally said the exact same thing. It is the team. Don't care about the technology, and we've watched too many bad teams take a great technology, drive it into the ground. So I was very happy to say that you led on. And I'm going to challenge Terry to say, is there anything else besides team?
Not really, but actually having a business model with a clear view to sustainability, obviously, is important. I do want to add something to Nishka about, and it was the question in the Q&A about what management teams can do thinking about future rounds. And the only thing I'll add on that is, I think you need to, as a management team, you really need to understand what your critical success factors are. And sometimes those are not what management thinks their critical successful factors are, but also to understand how those drive value in the business. So how does that actually create value for the investors? And once you understand that, you can then think about what milestones do I need to achieve to get to that next round of funding. And the only thing I want to add on the investor side, James, is I think you're right. The amount of dry powder, if you go back to Q1 of this year, was the most dry powder ever in the history of VC and private equity. That's coming down a little bit now. So there's, I think of the VCs as Scrooge McDuck sitting on big piles of cash. So there is money out there. And that money is being invested in those good, sound technical companies. And both Sally and Nishka talked about that. The one thing that VCs are doing and private equity funds that we're seeing in some sectors They also have to deal with the fact that they have a bunch of investments that are underwater, and they're doing what they can to get the value out of those investments. So if you look at the activity in the VC space right now, there's been a lot of tuck-ins, there's been a lot of M&A, financing of M&A, there's even been some debt refinancings. And all that is just really about trying to maximize the value of their existing portfolio. So you have the VCs right now are a little bit conflicted in terms of what they're focusing on, whether it's that net new, bringing in new companies, or are they trying to fix their existing portfolio? So I think that's slowed down the market a little bit, but we're certainly seeing, like I said earlier, there's a lot of investment coming into earlier stage companies.
Yeah, so there's just a few questions in the chat that I'm not sure we'll actually get to, but maybe some of you can just provide some color on it. Obviously, team is a big issue, and how you manage through these issues is going to be a challenge. But in the last couple minutes, I would like to get just a quick thought from each one of you as to over the next 12 months, do you see more capital being raised, more capital being placed in, do you think that there's a sector that's going to actually attract more attention than others? And why do you think that sector would draw attention? Obviously, energy is being a big deal. We need it to survive, but there's going to have to be a transition. Where do you think the puck will go with investment over the next 12 months in early in the stages that we're talking about? Nishka, do you want to start with that?
Well, I'm an energy investor, so I'm gonna have to give you an energy answer. But I think we've done a lot of technology investing over the last few years, which is critical, absolutely. But I think where we're lagging is some of the infrastructure that is actually required to execute. So an example would be just electrification. I'm dealing with a lot of portfolio companies right now where parts, just like basic parts like wires, transformers, these types of infrastructure pieces that weren't super sexy during the investment boom, and people weren't investing in those companies. They were investing in the next generation battery technology company, and that was great, and that's still great, and that's going to continue because we need that those technology advances to continue. But I think there's going to be some bread and butter companies. We like to call it the pickaxes for the gold rush. But if we're going to make real transformation, we really need to start with our infrastructure. So I think you're going to start to see some investing in that space.
Thanks. Quickly, Sally and then Terry.
I'm more of a generalist, so I don't have a specific crystal ball on this one, but I am seeing a lot of companies in the smart building space. And, there are so many different targets that are out there that companies need to meet, different ESG targets, carbon reduction, etc. And so it's really encouraging to see many startups just nipping away at these targets by providing solutions particularly in the smart company space, whether it's with heating systems, lighting, windows, smart windows, managing occupancy of buildings, all kinds of things like that. So I personally think that's a pretty interesting space.
Thanks. Terry.
I'd like to go back a year and a half and say hydrogen.
You think so?
No. I think we're seeing a lot in analytics, very similar to Sally, sort of analytics, energy efficiency, and even some grid management type companies. And so very similar to what both Nishka and Sally said. But again, like all sectors, there's a number of subsectors that are healthy.
Okay. Thank you all. It's been a fantastic session. We much appreciated joining us. Looking forward to, and we'll see what happens in a year from now if we've made the calls correctly. So But thank you so much for joining, and I'll turn it back over to Nisha.
Thank you, James. This was a great session, as you said, and thank you everyone for joining, and thank you to our panel members too. Please note our next session is on accelerating growth through marketing on October 12th. I'm going to send the link in the chat for you to register. Thank you so much, everyone. Bye.
Thanks, everyone. Have a great day.